This is Nick here, and I'm about to go through the updated Fed chart book ahead of the Fed's meeting on Wednesday. So, the estimated normal longer run rate, nominal interest rate for the Fed funds is 3%, according to the Fed. You can see right now they're at 2%. That's for the upper bound of the Fed funds target rate. They are very much expected to hike another 25 basis points at the September meeting, going from 2 to 225. The framework here is that this is considered a gradual removal of accommodation. If and when they get to 3%, which is their estimated normal longer run rate, that would represent a neutral policy, and if they went above 3%, that would become a restrictive policy. Fed funds futures are suggesting that in 12 months, 1 year from now, the Fed funds effective rate will be 2.74%. The current effective rate is right around 1.875%. That's the midpoint of the Fed funds target range, which is a range, 25 basis point range right now between 1.75 and 2%. So the Fed expected to continue to gradually hike rates. This is a similar picture, just a slightly different way of looking at it. This looks at the number of hikes that are priced in, stated in terms of percentage points. So 1.41 percentage points priced in for hikes for this year, calendar year 2018 and calendar year 2019. 2 hikes have already been done this year. So this is pricing in 3.74 hikes for this year, 2018, and 1.9 hikes for next year, 2019, total of 5.64 hikes for this year and next. And that is basically you divide that or multiply that by 0.25, and that's where you get the 1.41 priced in. Then the Fed's really, I think, primary mandate is inflation. So here are the 2 key metrics. So the official target is 2% on the headline PCE year-over-year rate of change. So that's the black line here at 2.3%. That's been helped recently by base effects from the oil price, which should ease off, and so we'll most likely see that come down a little bit. Then the PCE core reading is right at 2%, so right at the target, and that is, I think, Powell's preferred measure for tracking inflation. Then inflation expectations as priced by the break-even rates, which is the difference between the TIPS yield, the real yield, and the nominal 10-year Treasury yield. It's right now at 2.2%. That has been pretty close to that level over the past several months. Then the unemployment rate ticked down to 3.9%, and the wage inflation rate ticked up to 2.8% here. So gradually heading higher on wage inflation. Hasn't risen quite as rapidly as we've seen towards the end of the previous cycles, and that's something that I would look for, is to see that continue, that wage inflation pressure continue to build through as this cycle continues. Then looking at some different measures for unemployment. So as I said, the U3 rate ticked down to 3.9%, still not back down to the 3.8, which we had a few months ago, which is the low for this cycle and basically the low for the going back a couple decades. Then here's the JOLTS report, the jobs openings and labor turnover survey. So that picture continues to look very positive. This used to be one of Chair Yellen's favorite metrics to look at to gauge the labor market. So we can see this continues to look very strong. Then Powell's talked about the prime age labor force participation rate, noting that it hasn't gotten back yet to its prior peak at around 83%. So I know he's monitoring this data point, and that's been pretty flat so far this year over the past several months' readings. Then looking at the prime age male labor force participation rate, that last few data points has shown this downtick here. If we did see that come up to that downtrend line, that could represent, I think in Powell's framework, a close to full employment situation. Then financial conditions continue to generally be supportive of the expansion and generally loose. So the Fed likely to continue hiking, I think, as long as these financial conditions remain loose. They are, in fact, trying to tighten financial conditions, but I think some, banks are easing lending standards and other things are going on that are essentially keeping financial conditions pretty loose currently. Then the quantitative tightening, you don't hear much about this, but this continues in the background. It's on autopilot with their reduction in the size of the balance sheet. So you can see that's continuing and the pace is increasing as scheduled. So that is, while the rate hike decisions are data dependent and made on a meeting by meeting basis, this one's pretty much set into effect and is continuing to work. I think to tighten. I think we haven't noticed it too much yet, but I think this might work to tighten financial conditions. As that continues, monetary policy is thought to act with a lag, sometimes as long as 18 months, and so the actions that were taken last year in 2017 may not be fully felt until next year, 2019. Then we'll get an update on the dot plot at this meeting, because the September meeting will have updated summary of economic projections, which includes the dot plot. But we can see the median dots here do project the Fed funds rate to rise above the neutral rate. The neutral rate is this longer run 3% rate here. So we'll see if there are any revisions on the dot chart. That certainly will be one of the things that I think the market is focused on. We'll also get the updated just general economic projections for things like change in real GDP, unemployment rate, inflation. Then the who's who at the Fed chart here, so a couple of updates. Mary Daly has been appointed the new president of the San Francisco Fed. She'll start officially on October 1st. So Esther George will actually cast the vote for the San Francisco Fed at this meeting. And then President Trump has nominated Nellie Liang for one of the Board of Governors positions. There are 3 vacancies there, one nominee now for one of those 3, but 2 remain unnominated. So I have the conclusion. You can check the PDF on the website, merkinvestments.com/research, and read the full write-up there. But I think fully expect the Fed to hike rates and to generally be gradual in their rate hikes going forward. Likely, I think, to pursue a December rate hike as well.